Student. Let's start a discussion on a very important topic, guys, which is a credit appraisal and lending framework in the infrastructure financing. We are going to discuss it is in a perspective of analyst and senior analysts in the development financial institutions like NABFID, where we discuss on the credit appraisal and the lending framework. So before we are going to start this video in detail, guys, I would like to request you guys, if you are new to my channel and if you are looking for the business analyst, quant analyst, quality analyst, or the development financial institutions analyst, senior analyst kind of role in the risk management stream, operation risks, credit risks, market risks, liquidity risk stream. So please do like and subscribe my channel because I am continuously creating videos on these topics. So let's start discussion, guys. In detail, I will give you the detailed explanations, and at the end of this session you will be able to understand and analyze your thinking and analyze your knowledge on this topic which I mentioned in this slide. So you will be able to differentiate the infrastructure project finance from the corporate lending. You have the clear idea how the infrastructure finance and the corporate lending are totally different to each other. And then we are going to discuss on the six pillar appraisal framework that is used in NAFAD, and you can able to understand that framework in details. So in that framework we should cover guides, the project viability, risk allocation, sponsor strength, financial model, security and waterfall, and the legal documentation. So all these 6 points we are going to discuss in detail in slide wise. So then you are able to identify, allocate, and mitigate the key risks in infrastructure. And you, after completing this video, you are able to understand what are the key risks are in the infrastructure projects and what that risk is different from the corporate lending. Then we are going to discuss the run the meaningful trace test and interpretations, interpret that like a debt service coverage ratio, loan life coverage ratio, or the project life coverage ratio, which we call the PLCR. Then the structure security, where we discuss on the water cash flow waterfall for the long term loans, how the cash flow waterfall, what are the process of the cash flows will happen in the escrow account or the trust retention account, and how the sponsor the how the lender will monitor these account, as the lender is here is a NABFID, development financial institutions. So the spot the red flag in the detailed project plan reports, cash and the financial models. We discuss this thing in the next slide. So let's discuss on why infra financing is different from the corporate loans. What are the key factors, which is the first point which need to understand to us. So there we discuss on the different attributes like a source of repayment, tenure, EV, security, and appraisal focus. So in a source of repayment, we are going to check the corporate balance sheets of the sponsor, how much does balance sheet, and the corporate loans are impacted and are recorded on the balance sheet of the uh, corporate loans are impacted on the balance sheet. But the different ball game in the infrastructure project finance, it is a totally different to the corporate link. Here we do the ring face SPV, and the cash flow is here play the more matters. It is under ring face SPV. So let's discuss on little bit about the ring facing. What is a ring facing and how it is different? So ring fencing is a financial or a legal mechanism that spread a specific portion of company asset income operation from rest of its balance sheets. It is an the financial and legal mechanism that we spread some portion of that company from their balance sheets. It's the first the it is not into the balance sheets, typically to protect the firm from the bankruptcy and manage the taxation. It ensures that assets are revised for a specific purpose and seal from liability equals and riskier, non-regulated and failing parent company. So it's not the coming in the failing companies. So banking in UK, the key applications, the public utilities, project finance and cyber security, asset protection, regulatory compliance, risk containment. So that's are the factor we use in the ring fence cash flows. So the tenure is the most important factor that differentiate between the corporate loan and the infrastructure project finance. So basically the corporate loans are 3 to 7 years, max to max 7 years, and the infrastructure project finance are 12 to 30 plus years, matches with asset liability. So the funds which we give to grow the infrastructure projects are locked for the 12 to 30 years. Then the key risks. So here the risk is a business cycle, management quality, how the business will work, how the management quality. That risk is also there in the infrastructure finance. But the key risks and the most important risks are totally different because the sponsor, if if the sponsor are not able to fulfill the requirement or not able to pay the principal and interest rate, so in that case, lender can be the owner and lender have right to sell that thing. So that's why the construction risks, demand, and regulatory risks are the key risks in the infrastructure project finance. Then we discuss on the security. So all assets are charges in the corporate loan. If suppose the default will happen on the corporate loan, but the totally difference in the infrastructure projects finance. So the security of the project assets, all the assets for that, the special purpose vehicle, that are the security, or the trust and retention account clauses, and trust and retention account is a security, and the share place is another security in the infrastructure project finance. Then the appraisal focus, so ratio leverage, risk allocation, contract tail period. So tail period is always the greater than the 2 years. Okay, so tail period is the project life minus the tenure of that loan. Okay, that is the tail period. So the entire the life of that project is owned by the sponsor or that project is not given to the government from that sponsor, that is defined in the contract, and the duration minus the duration of the loan or the loan tenure of that projects. So in the next slide, guys, we are going to discuss on key most important 6 pillars of credit appraisal framework. You should mug up, you should understand all these framework in detail, guys. So first one is a project viability, second one is a risk allocation, strain, sponsored strain, financial model, security and waterfall, legal documentations, and rule thumb if it is a unallocated is the latest risks. So let's discuss on. We are going to next slides. We are going to discuss each key pillars in detail. So first discuss on project viability, where we are going to look at the economic need, technical feasibility, and the environmental and social clearances. Then we are going to discuss on the risks allocation, who take the construction risks, who take the demand risks, who take the regulatory risks. So there are the different kind of risks, and who are the owner, and who where we are allocating each risk and takes the sponsorship. Then the sponsor train, net worth of the sponsor, track record, history of the sponsor, or the skin in the game. I will discuss more on the skin in the game in the sponsor strength side, guys. So let's keep in mind the skin in the game stand for how much the sponsor equity, or how much the sponsor equity, or the amount that invested in that ratio, the debt equity ratio. So it is in the debt equity ratio. Then the discuss on the financial model. So debt service coverage ratio, project life coverage ratio, or the loan life coverage ratio, stress testing, sensitivity analysis, scenario analysis. We discuss all these things in the financial models. Then the security and waterfall. We discuss on the trust and retention account, DSRA account, debt service retention account. We discuss on the major maintenance retention account, charge on contract, Then lastly, we discuss on the legal and documentation, concession agreement, substitution rights, and ICF. We are going to detail this thing in detail. So, rule of thumbs: if risk is unallocated, it is the lender risk. So let's discuss on the first pillar where the project viability checklist we are going to discuss in detail. So technical due diligence and economic and the environmental and social clearances. So in the technology we are going to discuss is that technology is a proven, unproven technology. So unproven technology is, guys, the student is using the AI, ChatGPT, Copilot, or the uh, or Copilot or the Gemini to write down the essays, to write down the mathematics formulas, to utilize the do the calculations to complete their assignment. So suddenly, how the quality of work of that student is increasing. So it is an unproven technology. So the technology should be proven, and it is a first of kind. The EPC contract, it is the most important contract, guys, that will be make with the Larson and Turbo or the different the engineering, procurement, and construction contractors. Tata is one of the leader in that sector, in the construction sector, who create the bridge is in the infrastructure project. So the fixed price, fixed time, LDs, the performance guarantee, and the schedule realistic. Commercial operation date versus the aggressive DPR claims are the schedule in that the project. So let's discuss on the economic and environmental and social. So equity holders are the interest rate return should be greater than the 12% and acceptable even the financial interest rate return up sub the commercials, and it will be minimum. So equity interest rate return should be a greater than 5%, and it should be a more than 4 to 5% of the market returns, because it is that level. So why they will take the risks? They will invest it in the market product. So independent traffic and demand study, we use and we do the independent traffic and demand study using the probability of 90, not use the probability of 50%, because the chances of that the study will have higher as compared to the other things. And then all clearances in the we need to all the clearances like environmental, forest, land, or the grid connectivity, or the National Highway Authority of India itself authorize that before start we are going to start the projects, there is a 90%, more than 90% of land acquisition will be happen before the project is allocated to the project sponsor. Then the environmental and social compliance, IFCPS, and the equator principles are there. So let's move on the next slide, guys, where we are going to discuss on the pillars two, where the key risks and its mitigation techniques. So we are I will differentiate the risk category, and in that category who should take it, typical mitigation, and the key documents that will help for that this kind of the risks. So first risk we are going to discuss on the construction risk, and who should take it is EPC contractor. So EPC contractor is who take a contract of that project is a engineering, procurement, or construction contract. There might be the EPC contract is a single person or the multiple person. It will depend on the cost of project or the project things. So the typically mitigation technique that will use by the sponsor or the lender, it should be the fixed price EPC contract, LDs, or the 10 to 15 contingencies in that the project. So the key document is EPC contract agreement. It is the key document that we use and refer if the construction risks will happen. Then the demand and offtake. So government or the off-takers like the National Highway Authority of India or the Solar Energy Corporation of India Limited. So these are the different off-takers in India. So power purchase agreement is the document, or the off-taker pay or the concessions agreement, that are the typical tools we use to mitigate the demand and offtake risk. So the key document is the concession agreement and the power purchase agreement. So let's move on. The next risk category is a regulatory. So regulatory category will take or the owner of that category will be the authority, like the National Highway Authority of India or the Social Energy Corporation of India, or then the Air Authority of India Limited, Airport Authority of India Limited. So change in law and the compensation. If change in law of the compensation, then the concession agreement will be the key document in this case. So that case we will look at the concession agreement and the compensation. So let's move on the interest rate. So where the sponsor and lender are the responsible for the interest rate risk. So they need to use the hedge, rate cuts, and the development financial institutions fixed rate. So that different things that will use to eliminate the interest rate risk. So there is the in interest rate risk there is, if they take the finance from the foreign or the Indian and suddenly change in the interest rate, so they use the hedging technique, or they hedge the forex exchange rate. So loan agreement is the most important thing between related that thing, and the termination. So the authority is the responsible for the termination risk. It is at the most important risk. So termination payment and covering debt. What are the clauses that we cover in the termination phase? We write that in the concession agreement or the substitute and the agreement. So that's all these things slide in that document, how the termination will happen. So these are the last key risks and the mitigation. So let's move on the next slide, guys, where we are going to discuss on the sponsor assessment a red flag. So sponsor assessment red flag. So where we discuss on the financial strain, track record, skin in the game, and the bandwidth of that things. And so the financial strains. So the net worth versus the total commitment or the group leverage or the contingency liability. So we are compare or we do the analysis of the financial strain. So what are the total net worth of that the sponsor and versus the total commitment that sponsor will give to invest in that the projects, or the group leverage, how much the group, how much the large of that group of that sponsor, and the contingency liability. So the tier one capital we are going to invest in the individual project is not that more than the 20% of that the book size of that bank, or in the second the group go for the group project, we are not going to give for the 30% of no, 25%. Sorry guys, I'll make 25%. So that things. Then the track record. We will check and verify all the records of that the projects. So the project deliver on the history, how the project will deliver, duration of that project, is that project is generating. So we do revenue of that project. So time, any NPS or arbitrage history for that project. So we check all these things in the track record. Then skin in the game. So minimum 30% equity for greenfield project is a important. So skin in the game, how much the percentage of the equity are invested in that the projects or in that the special purpose vehicle from the sponsor. So was the quasi equity or the ICDs, then the bandwidth, one promoter, 10 SPVs, or the execution risk. So what are the bandwidth? How much the SPVs of that the sponsor? So how much the sponsor group are there? That how much the SPVs they have, and how much the execution risks, and how much the capability of they will work on such SPVs. So deal breaker cross collateralization across the group, promoter or leverages that we take in the factors. So let's move on the next slide, where we are going to discuss on four pillar financial model and the key ratios. So here we are going to discuss on different ratios and the greenfield benchmarks and interpretation. So there are the two types of the projects. One is a greenfield projects and another one is a brownfield project. So the greenfield projects is a project that is a totally new, that is starting from the scratch, where there is a no construction will happen, and it will be the fresh the project where all the documents and all these things required, and all these clearances will their involvement. And here is the most important risk is a construction risk. But in the brownfield project there is a no construction risk. We have the past history. So in the greenfield project we don't have the past history, but in the brownfield project we have the past history. We can check and analyze. We need to, in the greenfield project we need to do the traffic risk or the demand risk, but here already have the traffic and the demand, so we analyze that thing and predict the future thing. So that's the difference here between the greenfield project and the brownfield project. So the minimum debt service coverage ratio is greater than or equal to the 1.2x, and the lowest point of debt service is a cautions, and it will be take care of, it is a minimum that thing. And the average debt service coverage ratio is greater than equal to the 1.3x through the cycle debt service ability, which you continuously track. And then the debt service coverage ratio, how we calculated the debt service coverage ratio. So we will debt service coverage ratio is calculated for the 1 year, and it will calculated the every year. For the duration of debt service ratio is a 1 year. So we calculated that the total cash flow available for the debt service, which is nothing but the revenue generated from that project, minus the operation and maintenance costs or the statutory debt, okay, statutory or the taxes due. So that is the cash flow available for the debt service divided by the interest or the principal, is nothing but the debt service paid by this paid by that need to be paid from that the project. So that's the mechanism of the debt service coverage ratio. And the average debt service coverage ratio is nothing but to sum of all the debt services for the project life and divided by the number of years in that project. So that should to calculate the debt service average debt service coverage ratio. Then the loan life coverage ratio. So loan life coverage ratio is one of the also more important ratio, and as compared to the debt service coverage ratio, it is the longer the duration ratio, and it is calculated on entire life of that project. So it should be greater than 1.3x. And to calculate the debt service loan life coverage ratio, we use the formula for the net present value of the cash flow available for the debt service for each year. So we discount them and calculate the cash flow available for the debt service and the outstanding debt. So how much the principal and the interest we paid on that the loan or the project finance. So the project life coverage ratio, it is always greater than the 1.4x. So we can understand that the debt CR is the project life coverage ratio is more than the loan life coverage ratio, and loan life coverage ratio is more than the debt service coverage average debt service coverage ratio, and average debt service coverage ratio is more than the minimum debt service coverage ratio. So quotient project life the reduces, so it will calculated the entire the project lives, not on the project finance life. And equity internal rate of return, so it should be more than 14 to 15%, but minimum it should be the 14 and 16%. And the commonly it should be greater than the market rates return with 4 5 to 6%. So sponsor initiative to complete that thing, and the sponsor will more interested in that projects to complete that projects within the time and within the budget. So let's discuss on the fourth slides, where we are going to discuss on the mandatory trace states. So where we discuss on run the five scenarios in the every model. So first one is interest rate, time, cost, revenue, operation and maintenance, and combine all these four. So the interest rate, we consider some factors where the base of 20 basis point through the loan life. If suppose the 24 basis point, the low interest rate will increase. So what are the impact on the project? So time and cost. In case suppose the 6 months delay or the 15% cost overrun will happen, or the maintenance and the operation cost will impacted by 15% increases. So what are the impact on that project? So revenue, so 20% haircut in first 5 operating year. So basically haircut, let's discuss on the haircut. So what is haircut? Haircut is a thing, guys, where suppose if we have the 100 crore projects, and the due to the some scenarios, you are not able to the loan value of 100 crore, you are not able to sell that project with the 100 crore if the sponsor will not able to repay you the principal and interest rate. So you send it that to the asset reconstruction companies, ARCs, asset reconstruction companies, with 95 thousand crore. So you lose a 5,000 crore. So that's the haircut for you guys. So operation and maintenance, if suppose 25% increase in over the base case, what the base case we consider, if we increase the 25% and combine the 6 months delay plus 10 plus revenue haircut and the 100 basis point rate increase. So we consider combine all these things and do the stress testing, scenario analysis, and the sensitivity analysis. So action trigger, if debt service coverage ratio is minimum 1.x in any 2 year period under the combined trace, so that need to be action structure on rejects, mitigate the higher debt service reserve account, sponsor undertaking, reduce the leverage. So that thing we need to take in mind. So let's move on the next slide, guys, where we are going to discuss on the security structure, the standard package for the NABFID deal related to the security structure. So first one is the first charge on all project assets and present and the future. So the lender will have the NABFID, or the development financial institution will have the first charge on all the assets of that projects if the sponsor will not able to pay the repayment and these principals, and the place of the 51% of equity shares of special purpose vehicle. So and the trust and retention account will define the waterfall mechanism, or the trust and request. So we discuss on the next slide, where the how the waterfall mechanism will happen in the trust retention account, and the assignment of project contract, insurance clearances, or the different contractor will inform or sign that projects, or the debt service reserve account. So we calculate it, we consider it as a DSRA. So 1 to 2 quarter power principal and the interest we take in the FD's form in that, or the cash in the debt service reserve account. So if there is any event or any uncertain event like the COVID-19 in some duration, that the sponsor will not able to pay you the principal and the interest rate, so we cover from the DSRA account for that thing, and the sponsor support. So CCDs, or the cost overrun, debt service reserve account shortfall under taking, so that need to be considered. So let's move on the pillar 6, the trust retention account cash flow waterfall. So how the cash flow will happen in the trust and retention account, and it is and the most important, guys, you should understand. So priority of the payment. So firstly they will give, it is it is always conflict between the first will go to the statutory dues and the taxation, or the first will give for the operation and maintenance expense as per the lender independent approve the budgets. So the lender independent engineer will approve the projects for the each project's milestone. So accordingly we do that thing. So because some consider the operation and maintenance first, because there is no cost for the operation and maintenance, so how we can run the business. So that's the things there. So debt service to the NABFID or other senior lenders. So third will get the funds from the debt service, and then the if there is a fund we remove from the DSRA account, or if we need to keep some for the major maintenance reserve account, so the DSRA will top up to require and to store some funds in the major maintenance reserve account. If there is uncertain event will happen, so we will pull funds from the major maintenance reserve account and utilize these funds. And the NAFAD is signatory for trust and retention account. No diversion is allowed for the kind of the trust and retention account. And it is and the most important thing, guys, you should understand in detail the trust and retention account. So let's move on the next slide, guys, where we are going to discuss on critical legal documents. So beyond the loan agreement, ensure these existing document, and which is the most important document, guys, which is you should understand. And while you are working and the senior analyst in the National Bank for the infrastructure financing and the development or other development financial institution like NABARD or like the NHB or the SIDB or the Exim Bank, you should understand these documents. So the concession agreement, where you are going to check the terminations, payment, change in law, force majeure, different kinds of risks, EPC contract, who are the owner of that risk, or the project closure call law clauses, or the clauses in that the projects, payment clauses, milestone achieve, fixed term or the floating rate contract. So that's all these things we are going to see in the concession agreement. Then the substitutions agreement, so lenders step in right on accurate default. So substitution agreement is the most important agreement in a prospective NAFPAT. So in case the sponsor will not able to pay the principal and interest rate to the NABFID or the development institution, so the substitution and agreement will come into the picture. And as an analyst, you need to go line by line for the substitution agreement. Then the type parties agreement, so decision rule, enforcement mechanism, insurance assignment, all the policies assigned to the lender, and we need to check for the insurance assignment in that case. Let's move on the next slide, guys, where we are going to discuss on NABFID lending framework. So how the NABFID lending framework typically will look like, and what are the key things in that. So the disbursement, so link to equity infusion, milestone completion, plus the lender independent engineer certificate. So this way the distribution will happen of the funds. So the features and the NABFID standard. So ticket size, typically the ticket size is greater than the 500 crore. So it's more than the 500 crore of that projects, the infrastructure projects, and it's required the huge amount of investment. Then the tenure up to the 25 to 30 years of the tenure of infrastructure project. And the clustering repayment. So clustering repayment means the variation in the repayment are leveraged to the sponsor on the basis of the project of the progress or the revenue that generated from the projects, or the different factors that affected on the project's revenue generation. Then the moratorium. Moratorium is a period that given to the sponsor. So in some duration, like supposing consider construction period over the 6 to 12 months of this that project is completed for the stabilization, and in that period there is no issue of the principal and the interest rate. So after that they start to giving the principal and the interest. So that's why we need to consider uh, the delay of that project. So because the if the project get delayed, the moratorium period will get increases. So the products, the term loan, takeout financing, and the credit enhancement are different projects that will be used. And the pricing, base rates and the spread based internal ratings are the base pricing. So let's discuss on the second slide, guys, where we are going to discuss on the common pitfalls for the analysis. What are the common pitfalls? So pitfalls and what to do in that pitfall. It's suppose there is a probability of 50% of generating the revenue, and that matches with the requirement or the cost of that project. So it's the probability, it's just the 50%. So demand it to 90% study. So do the 90% study demand, and air cut base should be the 15 to 20% that need to be analyzed, and that need to be do. So low operation and maintenance cost. So we need to always prefer there will be the operation and maintenance costs are minimal and get the more good and accurate results. So benchmark with 3 operating project and buffers. So weak concession agreement, no termination payment, or the large or no gaps. So high leverage. So the 80 to 20 with no contingency and aggregation. So debt to equity ratio should be 70 to 30 or 80 to 20. So the high leverage should be there, and the refinancing risk. So in short, the stale period is a 25 more than 25% for the concession agreement, and that need to be ensured. So in the last slide, we are going to discuss on the key takeaway from this video, and it is and the most important thing, guys, for you to understand the key takeaway. So the contract is more important than the assets. So contracts are the important, are the documents are the most important in these projects. So documents are we know that the assets for the bank. So first asset is the cash, and second assets for the data. So documents are also the part of the data. So in infra, we lend against the cash flow and contract, not the lands. And the reallocate the risk. Every risk must sit with the primary base to be manage it. So every risk will be there, and the stress matters. So base case always looks good, or underwriting is the set down, and the security is protection. Trust and retention account, DSRA, debt service reserve account, tail period, you are real the security and the development financial institutions. NABFID can take calculated risks for economic benefit, but not credit the risk. So you can take the risk but not credit the risk. So this is the end of this interesting seminar, guys. Thank you so much for guys for attending this seminar. I would like to request you guys, if you are new to my channel and if you are interested in the credit appraisal, lending framework in the infrastructure finance, or the NABFID roles like the analyst or the senior analyst. So I'll continuously creating videos on this topic. So please do like and subscribe my channel and watch my all the videos. Thank you so much, guys, once again for attending this interesting seminar.